Hey guys, this is Doc Huffpower coming to you from my studio here in Alvin, Texas. Today we've got an absolutely fantastic guest for you. It's someone who's going to really help you to get the most out of your business and teach you a whole lot about how you can keep some of your hard-earned cash. I'm talking about none other than Harsh Patel. He's a CPA with many years of experience, specifically in dental. And today he is going to tell us a couple of the things that a lot of dentists don't know to do every year to save money or even get money back on their taxes. Hey folks, welcome to the Dear Doc podcast, where we discuss the practical aspects of running your dental practice, as well as the technology, softwares, and services that can help to empower you as a dentist. I'm your host, Doc Huffpower. Thanks for joining us for today's episode. Before we get into today's program, I'd like to talk to you a little bit about one of our sponsors, DocSites. DocSites provides affordable and effective websites for dentists with no long-term contracts, transparent pricing, and great customer service starting at only $59 per month. They also provide optional online marketing packages to help you increase your online visibility. For special offers, including up to 25% off of your website setup, text podcast to 818-489-9823. Again, that's 818-489-9823. Now, this is a limited time offer, so text now and lock in your savings. Or you can visit docsites.com/TBOD for more information. So with no further ado, Harsh, how are you doing today?
I'm doing great. Thanks for taking me on, and I'm really looking forward to getting started with additional layers of tips and looking forward to helping out the dental community. I'm doing great.
Fantastic. So before we get down into it, tell me a little bit about what it is that drew you to be a CPA. Because, you know, you and I have talked a lot, and you don't seem like the normal CPA to me. No offense. I hate it when people say that because it always is followed by I hate dentists. But no offense, you're just not boring. And, you know, our stereotypical idea of what a CPA is like is this boring guy, you know, with a pocket protector, and you're a really cool dude. So what led you down this road? What inspired you to become a CPA?
Yeah, for me, I mean, it started a long time ago. I mean, my family had businesses, and my dad had accountants and CPAs, and the biggest thing I saw was a lot of communication, a lot of different layers of issues, and just different ways how he can improve his business further. He wasn't really receiving that layer of treatment. So I really, at a young age, started helping him out, doing the books, and as a teenager, and I got a lot of exposure. And I decided when time came that, hey, let's focus on accounting. And I eventually wanted to open my own firm. So that's kind of where it all started. And now that I am a CPA, I know the main pillars and things to focus on, and kind of changing the game up for the future.
Fantastic. Now, I know that you have helped a lot of dentists over the years, and I believe you also help people in different professions. So if these dentists have wives, you may know some of the things that they, as different professions, might be able to write off that they don't generally think of, or that less well-trained CPAs don't think of. I know for a fact there's a couple of my favorites that you're going to cover today, like easements and Augusta rule. But before we get into that, can you tell everybody how they can contact you if they're in need of a good CPA? And then we can get down to you just sharing some of your knowledge with them.
Sure. Yeah. There's several different ways to contact. We have a booking link to directly book. Additional ways to contact is directly to the website. So you can go ahead and submit an inquiry, and then we'll get back to you and schedule a meeting. And within that, after, we can get a nice analysis and just do a full overview and kind of see where you stand, and offer additional areas of tips and advice that we can just help to take your business further and reduce your tax burden at the end of the day.
Fantastic. Okay, so before we go any further, I'm going to have you go ahead and give me the phone number.
Yep, the phone number is 224-625-0484.
Fantastic. So guys, if you need a good CPA, go ahead and give Harsh a call. Now, Harsh has not paid me to do this, but Harsh has done some work for me for some of my other companies, and just always found him to be really refreshingly full of candor whenever it comes to taxes, you know, and lots of great information. So, Harsh, let's get down into it. I've got some notes here. Pardon me for looking away from the screen for a moment, but yeah, I see the first one is exactly what I said. The Augusta rule. How many people forget the Augusta rule on their tax return? it's impossible to me to do that because it's one of the first things I learned. But talk to me about that. Is that a super common mistake?
Yeah, it's huge. And that's one of the first things when I jump on a call, I'm like, hey, are you utilizing this and that? And one of the first questions, hey, are Augusta Rule, are you familiar with that? And unfortunately, a lot of dentists themselves or owners themselves are not aware, simply because they haven't been provided the guidance or just never brought up to them. But yeah, it's a large chunk, and I think a lot of people can qualify easily, and it's underused.
Now, if I'm not mistaken, it originated because of the Augusta golf tournament. There weren't a whole lot of hotels in the area, and the homeowners in the area wanted to be able to allow people to sublet their homes and stay there during the tournament. And so there was a special tax relief that was passed just for that area. And then I think it was ratified that it had to be offered to everyone in all states or something like that. And if you don't mind, give us a brief overview of the history of it and tell us how to use it and what it is exactly.
Yep, that's exactly what you mentioned, and it started off on the golf course, and now it's kind of spread out everywhere for the federal level, and pretty much what it entails. So imagine yourself as a practice owner, and hey, like you're using your home as business, right? So if there's holiday parties, meetings, additional areas of business that you conduct at your house, certain times you do use up your house, maybe the full day or partial day. So what you can do is write this off 14 days out of the year, so there's a full 14-day exclusion, and essentially you take the expense on your business, and then on the personal side you have that 14-day exclusion, so you don't claim any income on the personal side. So essentially you're renting your home as business for 14 days tax with a tax deduction.
Okay, so a lot of people get really confused about that one, and they're like, well, how do I know how much it is? And then someone will pipe, well, you can only rent for like $200 a day. Guys, that's not true. You can, if I'm not mistaken, this one I know pretty well because I use it. I believe that you can rent it for what equivalent accommodations for the nearest conference center or venue that could hold the meeting that you are holding in your home would rent their space for, given the amenities that you are providing. I think that's the wording, something similar to that.
Correct, and that's exactly what it is. Essentially, you take the fair market value of something in your area, similar like a conference center, essentially whatever you're hosting. If it's a bigger party, you need a bigger room. So just take the fair market value, something in your area going a rate, and you go ahead and apply that, and then you just make the proper documentation and just go ahead and expense. And there's a lot of due diligence in the back end, but it's pretty straightforward, and it's something we do assist with going forward as well.
Excellent. And guys, just so that you know, I mean, if you've ever rented a venue for a meeting and you've got an open bar, that's expensive. That brings up the cost. If you got a pool at your house, that's expensive, brings up the cost. Catering, you're providing food for the people. There's so much you can do. Harsh, what is the highest amount you've seen? And guys, I'm not telling you to do this. I'm just telling you should assess it. But what is the highest amount you've ever seen somebody take whenever it comes down to the Augusta Rule? How much have they taken in a day?
I would say the largest I've seen was close to 5K. Obviously, it differentiates depending on the size and what's kind of involved in the meetings and whatnot. But yeah, that's probably what I've seen. And essentially, you can do it 14 days out of the year. It doesn't
70
mean,
grand, baby.
You do it every time. But yeah, I mean, it can add up to large amounts, and it's essentially every single year, so there's no harm.
Absolutely. I love it. I love it. And real quick, I'd like you to familiarize our viewers with a couple of terms, above the line and below the line. And every single one of these tax, I already know the answer because I looked at ones you sent me. After every single one of these tax questions or tax tips, I want you to tell them if it is an above the line or a below the line deduction or a credit. So go for it, man. Above the line, below the line, credit. Please define.
Yep, above the line, essentially you're taking adjusted gross income. So essentially what that includes is your wages, additional layers of income, and additional deductions. That's kind of factored in above the line. And after you have your adjusted income, there's different tax credits. So different federal tax credits that's kind of applied to that. And then there's a standard deduction that's below the line as well. And once you take everything below the line, you essentially have your taxable income. And then after the taxable income, you essentially say, hey, this is how much tax you're due. And then you go ahead and offset against credits or payments or additional things that you've paid throughout the year.
Fantastic. Okay, so all that being said, best things in the world are above the line. Above the line.
Yep.
So we'll get into the second one, which is, I believe, one of the above the line deductions, which is why I made a big deal out of that. Cost segregation for purchases, renovations, and building construction. Let's talk about that real quick. What is it? Who qualifies for it? And when is it too late?
Yep. So yeah, essentially most business owners can qualify for it, but there's different layers and requirements behind it. So essentially, if you're, for example, building and doing a new construction of a building ground up, you can do the study then. If you're remodeling your office or you're acquiring a practice, there's different times where you can kind of utilize this. And what it entails is you do a full study. It's called a cost segregation study, and you kind of differentiate each layer of your assets into different sectors, and then you go ahead and analyze that. Certain assets are qualified for advanced depreciation, bonus section 179, and there's different layers of requirements. The laws are changing behind that as well. So it's good to do a study. Certain times you can get up to 70, 80% as a full deduction in the project cost in that first year. So it can add up to a large amount. And since you are doing the above the line deduction, up to 70, 80% of the project, your taxable income drops significantly, and then your tax bracket drops. So it's a win-win, and then you can go ahead and apply that, keep doing that with additional investments, different practices, or whatever it is that you're kind of investing in. So those are the three main pieces to always watch out for. And then if you did not utilize it, you can go ahead and amend returns as well. So that's always in there. And it's always good to kind of take a second look. And if you do need to amend, then it can save you significant chunks of money. There's no harm.
Absolutely. And guys, something you should all keep in mind, and you can look this up. It's in the tax code. It is your duty as a citizen to pay the least legal tax that you can pay. It's in the tax code. It says it's your job. So you guys are slackers. You need to deduct more. So in this previous example with the cost segregation, imagine that you just purchased a building, okay, and you've got it on a 30-year note or what have you. Usually you'd be deducting maybe the cost of your mortgage or what have you. And Harsh, you can correct me there. I'm sure I'm wrong on that one. But what you do with this cost segregation is you have somebody come in and they say, hey, look, your roof's 25 years old. It's a 30-year roof. It's only got 5 years left. You can deduct that over 5 years or what have you. The walls should last you 50 years. So you can deduct that over 50 years. And then you just cut the building up into small pieces. And each and every single one of them becomes a unique deduction. That's an above the line deduction. And so you can have some considerable tax savings by doing this, particularly those of you guys who are in real estate or getting into real estate. If you are not doing cost segregation, you are screwing yourself. So did I get that wrong? Is it the mortgage you deduct as a payment?
Mortgage,
business expense?
So essentially you take the fair market value of what you're taking in, say if it's $1 million building that you acquire at that time, you go ahead and take the purchase price, and then you go ahead and do the cost segregation on that amount, right. Say 400K for this, right, 300K for that.
Without the cost segregation, how do you deduct that building correctly? Because I always rented for mine.
Yeah. Yeah, so there's two different layers. One is land and one is actual building. Conservatively, people do around 20% for land. It could be more or less. And the remainder part, say if it's a commercial building, the 80%, essentially that gets depreciated over 39 years, and it's not going to add up to a large significant piece. So you go ahead and take that large chunk and do the study, and then you could probably get 70, 80% that first year instead of just doing a small portion for 39 years and not really seeing much out of it.
So, by the way, guys, if you overpay your mortgage, you're going to pay income tax on that, just so you know. Ask me how I know. Before I ask smart people to teach me how to do this stuff. So the next thing we're going to cover is QBID, or Qualified Business Income Deduction. Now, this is one I'm not familiar with. Harsh, school me, my friend. Talk to me a little bit about it.
Yep, essentially, so there's a lot of qualified businesses and large ones, medical professionals, doctors, dentists as well, as they're included in that category, physicians. So they're all subject to the qualified business income deduction. And what that is, it's a below the line deduction. So you have a K1 flowing in from your business, for example, 200K that's coming in, and that's subject to 20% and QBI, so qualified business income deduction. So automatically you have the 200K coming in, but then at the bottom of the line, you apply that 20% directly on that 200K since it's a qualified business, and you automatically get that 40K in deduction right there. It is subject to different layers of requirements, depending on the business generating income or loss, and there's always things to monitor behind that, as well as your income tax, just your adjusted gross income as well. So if you're at higher up brackets and higher up income status, then essentially the studies and the cost segregation really do impact that. So if you did a cost segregation, for example, your tax adjusted gross income and taxable income is lower, and then you can go ahead and qualify for the qualified business income deduction, which is an additional deduction on top. So these things really do impact each other, and it's always good to get a second look at it. And
they need
it's
to be
often missed.
understood, because if you use them in conjunction,
Yep.
like you were just saying, you may not qualify for a QBID, but if you do your cost segregation, it might bring your income into the level where you do. So this is something that you really have to have someone. I don't know what you would call it, Harsh, but I call it a tax planner, a strategizer, and not a tax preparer. Because there's a lot of tax preparers out there, and you're not going to get any of these deductions with them. Their job is just to walk the straight and narrow and stay as far on the white side of the gray line as they can. They don't want to cross over that gray line into bad territory, so they don't even get near it. Whereas a tax preparer or as a tax strategist is someone who's going to look at the gray line and say, in this case, you're actually a little on the white side of that line, so you're safe here, but we can't do this one. Right?
Yep, there's preparers who is just like a one-time thing, and essentially you can't really know as a preparer, okay, like here's the financials, you go ahead and prepare the return. But as a strategist and planner, you need to do planning throughout the year. It shouldn't just happen annually, and
Absolutely.
That's where it comes into play. You go ahead and strategize, whether it's investments, and utilize these different studies, deductions, and you should know where you stand throughout the year. And then when you apply all of this, and your tax income and taxable income should drop, your deduction should increase, and your savings should definitely increase at that day as well. So it does impact each other.
Well, I'll tell you, one of the things I always tell people is they need to be having a meeting with their tax professional, their lawyer, and their financial planner together at least once a year. And for some people, maybe more. So,
Definitely.
Go ahead.
Yep. Yeah. Within that, like I definitely suggest quarterly as well. Tax estimates are due quarterly, and your whole business could change. And one day it could go from $1 million of collection. Next year it could be $3 million.
Right.
And the whole tax situation is different. You need to apply different layers of strategies. There's changes in laws and regulations throughout the year. It just doesn't happen at the end of the year. So it's good to know where you stand, apply the strategies, and within the meetings itself, it's a nice dedicated meeting, and it could save you thousands of dollars just by sitting down for an hour and discussing your business.
Well, I know in my instance, so that you guys know, if something like this changes in your life, you need to have this meeting with these guys. I opened a new business, and then we opened the dojo. You remember we were talking about the Brazilian Jiu-Jitsu dojo down here. And so my tax structure became a lot more complex. And I also invested in a couple of companies, and I was a partner in a couple of companies. And so our CPA said, we really need to talk to your lawyer about different structures, because everything is done as a PLLC or an LLC, and they're all standalone structures. But if you nest them this way, and he started drawing on a napkin, he said, okay, and you make a C Corp over here and an S Corp over here, and the LLC's over here. So you're protecting your assets in this layer, and in this layer, you're paying taxes in this layer. And I was like, why did no one ever tell me all this stuff before? I'm not kidding you. I saved $200,000 in taxes that year. Hell, this past year, our new CPA, we saved, I think I'm getting a $350,000 rebate because we had overpaid so much already, because we had another CPA that weren't doing a good job, so we fired them. But having the right CPA in your corner is super, super important.
Absolutely. And yeah, the structure and everything behind it definitely makes a huge impact. And the littlest changes, it's a one-time thing, and having the right structure and reassessing everything, it can save you thousands and hundreds of thousands of dollars. And that happens all the time. And it's one of the initial questions I always ask on onboarding calls. Okay, what's your structure? And immediately I'll have a red flag in my head. I'm like, hey, this could be wrong. And once you reassess, reanalyze, and change everything up, and just immediately then you're subject to a lot of savings. And it's not something that's illegal per se. It's just you're doing it correctly and structuring it correctly, and it's really out there for you to use.
I like to say optimally. It's all correct. It's all legal. It's just, this is optimal, and you don't want to pay any more in taxes than you have to. So I kind of laughingly joke a lot of times, and I say that with my team, it's almost like a bunch of my own kids there. They listen about as well. But the truth is that they're great. The truth is hiring your kids. That's definitely a thing. And a lot of people don't know about that. Talk to us a little bit about what you have to do to qualify your kids as someone that you can hire in your practice, how old they have to be, how much you can pay them, and how much you can save in taxes.
Yep. So age is definitely, there's practice owners out there that if they're toddlers or in their babies. So within that, you always have to check your state laws if they do qualify for just wages and hiring them. But once they qualify, the next step is, hey, what can we use a baby or a kid for? Like the biggest thing, modeling. Go ahead and take pictures, photo shoots, put them in your office, social media. A lot of owners do that. So within that, you put them on payroll. And once you put them on payroll, you have to structure it correctly. And oftentimes, depending on the age and structure of your business, you can avoid Social Security, Medicare, and income tax by paying them. And it's a direct deduction on your business as well. And then once you use those funds that the child is earning, you can go ahead and reinvest that for them into different retirement plans, IRAs, backdoor IRAs. And essentially that money is growing tax-free. And you're also getting a deduction out of it. So it's a win-win. The child earns wages, and then if they are older, like, hey, you have them do administrative duties, and you can do things differently, and they can learn the practice, or eventually if they want to take off the business, you're getting a deduction. You're also teaching your kids, and they're also making money on their side. And if you keep them within certain income limits, you can go ahead and just avoid income tax on them as well.
Absolutely,
so
100%. Tax-free income that usually you'd pay taxes on, so that you could go and you could put it into a non-qualifying college fund, or so that you could buy them, a mutual fund or what have you. You've already paid taxes on that money. You're going to get taxed twice. They're going to get taxed. You're going to get taxed. Avoid the taxes completely. Just employ your kids. I'm sure they're cute kids. I mean, if they're not, you can say, this is what happens if you don't brush, So the next one we're going to talk about, is business entities restructuring. I'm sorry, I kind of jumped the gun on that one because I had a personal experience with it. But business entity restructuring, anything we've left out in the previous comment?
I think we kind of hit the main part of it, and whether you're a small practice or a DSO level, it's always, you can always have the wrong structure. So it's good to kind of get it checked out, whether you need a management company or different companies below, or change the whole structure within itself, looking at the payroll piece and dividends and distributions and calculations. So it's all impacts each other, and it's a domino effect. So some of the other things we did discuss, they all impact each other. So it's always good to get it reassessed.
All right. So the next thing we're going to cover is that a lot of self-employed owners forget that they're able to deduct their own health insurance. Oftentimes, if they are deducting, they are not doing it correctly, which can result in audits.
Search engine optimization, or SEO, is a hallmark of an exceptionally visible website. Here at Art of Dental Marketing, we know that it's crucial. It bumps you up to the top of Google search results and more. But did you know that it's also one of the only online marketing channels that can continue to pay dividends over time? At ADM, we expertly craft your online presence to help you evolve with modern marketing. For more information, search artofdentalmarketing.com or call us at 816-631-0954.
Correct. Yeah, that's something a lot of owners aren't familiar with, and something I do see a lot on the financials. It's really easy to spot is deducting it properly, and also the tax compliance piece. So if you aren't aware, you are able to deduct it as a self-employed owner. And the way it works is you take that deduction on the business, but you also have to show it on your W-2 as reported on your W-2, and then you go ahead and offset that and report it on your personal income tax return. And then from there, you take an additional adjustment and take that deduction on the income return for your personal. So
And don't
kind of flows from one to the other, but you can do it definitely wrong.
and don't forget, not only you're going to not pay taxes on you're not going to use post-tax dollars to get your health insurance. You're going to use pre-tax dollars to get your health insurance. Then you're going to transfer it to your personal income tax. Then you're going to get an above-the-line deduction that's going to wipe that sucker out. Or, guys, it's all a game. It's all just a numbers game. Now, your next one you want to cover is actually one of my favorites. And from what I understand, it's going out of favor. So I would love an update on this. Conservation easements are something that I've used the last 5 out of 6 years, but this year we were advised not to use them because of an increased chance of audit this year. Talk to us a little bit about that. And is that, BS advice, or is that real advice?
Yep. So conservation easement is pretty much a legal binding agreement for limited use of land between a landlord yourself, and you go ahead and have an agreement with a non-profit or a government entity, and essentially you're considering that land, and then you can just give that land access. You'll still have ownership, and then you can go ahead and claim charitable deduction, just the deduction on your side up to 50%, and there's different limitations and things you have to follow. But in terms of the audit piece, everything is always subject to audit. But if you're doing it correctly, you're documenting it correctly, and essentially if it's legal and there's no harm in doing it, just make sure you have proof and full support of everything, and that there's no harm in some of these things. But it's a nice deduction, and you still maintain ownership, and the deduction could add up pretty large sums.
Now, one of the things that a lot of people don't know about this, and I think I know, so correct me if I'm wrong. From what I've read, basically, when you're looking at a piece of land, let's say I have 3 acres that is right off of a lake, and I say, okay, well, I'm going to do a conservation easement, and I'm going to allow this nonprofit to use it, and the nonprofit is going to, I don't know, have a camping spot there, and they're going to launch their kayaks into the water, and maybe it's used by the Boy Scouts of America or something. The value of that land is not, let's say the land was worth $200,000. The value of the land that is assessed in the conservation easement is what is the optimal use for that land. The optimal use for that land would be to create a vacation hotel. And so you're talking real value here, guys. You can take a $200,000 purchase that you made of a piece of land, do a conservation easement on it, and easily get a few $1 million worth of deductions off of that. And these are above the line or below the line?
These are above the line. And then also the next thing is, since there are certain requirements and AGI, and if you have to hit that quota, but if you don't, then you could go ahead and roll it over to the next year. Yep. So it's there to use.
Excellent. Okay, guys, next one we're going to talk about is maximum retirement plans, or maximize your retirement plans to reduce your tax burden. And this one's one I've screwed up myself several times. And I have a complex problem for you. And I'll ask you on air. I don't mind if anyone knows my business here. So talk to us a little bit about that. How do you maximize your retirement plans to reduce your tax burden?
Yep. So as many business owners, what they do is go ahead and look into retirement plans. There's different layers of retirement plans, but the biggest piece is maximizing it. So obviously as a dentist, you have to pay yourself reasonable compensation. And within that, a lot of owners, sometimes they just stick on the cash and they don't know what to do with the money. So instead of just letting it suck up with inflation, you can go ahead and reinvest that. And the best way, depending on what you want to do in your investment strategy, is to look into retirement plans. So you can go ahead and reduce your tax burden. Certain times you can do up to 25%. It is dependent on your income and your salaries, but you could do that. And then also deduct on the business level as well, and that can add up to large chunks. But there are different layers. So sometimes you don't need to offer it to your employees. There's employer ones, there's employer and employee. And it depends what you really want to do, how much you want to invest, and essentially when you want to invest it. So there's a lot of analysis to be done on it, but it could add up to a large chunk of just deductions every year, and you're just obviously investing in the back end.
And if I'm not mistaken, that exemption is going to depend upon the employee classes that you have working for you. So your hourly employees are a different class than your contract employees, professional employees. And as the owner, you're again a separate class as a CEO, as opposed to as a dentist. So if you don't have a CEO position, you may not be eligible to exclude everyone but yourself. So guys, that's just, and correct me if I'm wrong there, Harsh.
Nope, you're right.
So basically, guys, just be aware of that whenever you're looking at this. And if you're not paying yourself as a CEO, maybe you should be. Like, I'd say definitely you should be. So claiming R&D credit. This is another one I have always fallen down on. And now that I'm not in my practice anymore, I don't know if I can even use it. Talk to us about how a dentist claims R&D credit, because there's a whole lot of hubbub about this, but everyone's kind of scared to do it because it doesn't make any sense to us because we're just a bunch of dumb dentists. So talk to us a little bit about that, Harsh.
Yep, I think it's more useful now than ever, simply because there's changes and technology and developments and different layers of how dentists are conducting their business as well. And just with the next phase and the next generation, how it's kind of focused on the technology side. One of the biggest pieces is tech. So whether you're changing your technology, implementing different systems, processes, all those things really impact this and the eligibility behind it. So that's one way. Another way is, for example, if you have a lab or you have different layers of equipment, procedures that you're just kind of doing R&D on, research and development, depending on what you're purchasing and where you're trying to implement at your practice. Certain times that does take a lot of hours, and you have to assess staff, and there's a lot behind the scenes. So you can essentially, that can get you enabled to do it. But there's quite a bit amount there. But the biggest thing to do is reassess. Certain times you are eligible, certain times you're not. But especially now more than ever, I mean, with the cloud and different layers of technology and pieces you implement in your business, I mean, you could potentially be eligible.
So and
it adds up to 20%.
Let me run something by you. I'm going to give you just kind of an off-the-wall, made-up scenario. I want you to pick out, for me, all the different tax deductions on this example, and including the R&D and which ones aren't and why. Okay, so I've got a friend down in Florida. Now, my friend, he does full mouth reconstructions, and he has this scanner and this CBCT I really want to look at. He's got an intraoral scanner. He's got an extraoral scanner. I think I'm going to fly down there, and I'm going to stay for a week in a hotel, and I'm just going to visit his practice. Now, after I visit his practice, I decide that I definitely want to do this, and so I register for a class. I take the class, I get some CE under my belt to learn how to place these implants. And at the class, they offer me a special deal. Now, does this sound like a lot of your dentists? Because this is exactly what happens to us. So they offer this special deal. And so I'm like, okay, well, I can save 20% if I buy a bunch of implants now. So I'll go ahead and I'll buy these implants. Black Friday comes around and I get a CBCT and a scanner. I'm like, I should bring somebody in to train my team on how to use these things. Which one of those things, including air travel, lodging, and renting cars, are tax deductions?
I would say most of it is simply because it is directly to your business use. So I would say mainly all of it, but obviously there might be little things here and there, but mostly all those things are deductible on your business, I would say.
What if my friend and I went out that evening, the first evening, and we went to a bar? I said, man, I love you, man. Thank you for letting me come here. I bought us both a couple of big steak dinners, and we just kind of shout the shit about our offices. How much of that's tax deductible?
Yeah, so if it's business related, then you can go ahead and expense that, and it's subject to 50% with meals deduction. So you can go ahead and expense that. The best piece of advice, if it's over $75, is hold that receipt per the IRS regulation. But yeah, you can, if it's a business meeting or discussing your business, you could go ahead.
And as of this year, Electronic documents are completely 100% legal with the IRS. So by saving the receipt, what Harsh really means is take a picture of the damn thing and stick it in a folder on your iPhone, and you now have better tax records than you probably ever had, because mine always ended up crumpled up in my wallet and ended up getting washed in my scrubs or something. I'd end up having like this pocket full of lint from the receipt instead. Okay, now we're going to talk a little bit about something that drew some harsh criticism a couple years ago, and as we change administration, I believe it always draws some criticism. But that is claiming business deductions for vehicles, for multi-practice and single practice, I believe, depending upon weight of vehicle, practice owners. So talk to us a little bit about that, and maybe the distinction between single practice owner and multi-practice owner.
Yep. So this always draws a big thing, and obviously with the technology and different layers of cars, electric cars, and the vehicle credits, and the size and the weight of the vehicle, and especially like what it's used for. So to start off, the vehicle deduction, you cannot use it for just commuting back and forth. So for example, you had a single office and you're just going to the office and back, you cannot claim it for that. But hey, sometimes a lot of the owners, they have an office, or then they're doing additional just contracting work or whatever on the side. You can go ahead and, depending how it's structured, if it's all structured into one entity, you could go ahead and just use that vehicle and claim it as a business vehicle for going from one location to the other. And then the next thing is like, hey, if you have additional meetings, or if you're meeting vendors or other things that you're doing business related, you can go ahead and use that. For multi-practice owners, like, hey, if you have like 7 to 10 practices or even more, they're just going around one practice to the other in the region, and essentially that you can go ahead and it's pretty much write off. And what you do for that is you have to say like, hey, what's the percentage of business use? So you go ahead and apply that during tax time and claim that deduction. The next piece is the weight. So anything above 6,000 pounds is essentially what you can write off the first year. There are new changes in laws and regulations, so 100% write-offs are kind of gone, but they're up to 80% in 2023. So anything by end of the year, you can go ahead and utilize that. For 2024, it's up to 60%. And then 2025, it's 40, 20, it kind of phases out. But if you do need it, go ahead and claim it. It's good to kind of take the advanced amount earlier on than in the later years where it may phase out. And then, hey, like changes in the administration, you never know what's going to come. Right. So as long as you know it, go ahead and do it right now.
So, I have to throw you a complex one, right? Okay, so I don't currently have a fleet vehicle, but if I purchased a Cybertruck, which weighs over 6,000 pounds, I qualify under weight. I also qualify for the EV credit. If I was a bigger business, I know I would qualify under the electrification of the fleet. I think that one's a credit, or it might be a tax deduction. And if I get some magnets made up and I stick it on the sides of that bitch, and everywhere I drive, even if I'm commuting, I've got magnets on it, that commute just became advertisement. How much of that can I write off, and where?
Yeah, so if it's for marketing and advertising, you can go ahead and write that. But the next piece is the EV. So for example, the EV credit that's really out there for the federal and certain states as well. You can't double dip on that with a business. So if you go ahead and write off your business vehicle, you can't claim that. So it's best to assess what's more the pros and cons of each, right. But usually writing it off.
I figured it was either or, but I know that they just announced something about fleet conversion. You can probably tell us more about it than I will ever know. I just read an article on it, and it went in one ear and out the other, but I thought about when you mentioned this. And it's basically you get this tax credit or a tax deduction if you convert your gas fleet over to an electric fleet. Can you talk to us a little bit about that and who would qualify? I know it's relatively new, so if you don't know about it, it's cool.
But... Yeah, I'm not fully aware of it, but based on essentially just what you're saying, it's at the business level, so I'm guessing it's more for larger fleets, and it may be directly towards trucking, or if not, if it's trucking, if it's general purpose, and even within the dental field, it's probably essentially a lot of owners have large fleets of vehicles, gas powered, and if you go ahead and switch that over to electric, there's additional layer of credit they apply at the federal level. strictly towards that.
It was an article about the tax breaks that Amazon gets for converting its fleet over to Rivians. So it's probably quote trucking, because those are delivery trucks.
Yeah.
But you got to try. If you don't ask, you don't get the write-offs.
Exactly. It's always good to reassess and just check where it's at. I mean, there's no harm.
And the last thing we're going to cover is payroll compensation for employees, contractors, and owners, and how to reduce payroll taxes as an owner and stay compliant. And that's a big one. So let's talk about that one at length.
Yep. So that's one of the biggest pieces. I mean, for example, if you're a startup, certain times you may not want to be an S corporation. A large batch of corporations are considered S corporation, simply because you can potentially save on payroll taxes. But for example, you're a smaller business, just startup or just maybe acquired, it's not generating too much income yet. So like, hey, I don't want to give myself the full payroll. I just want to reinvest. And within that, you might want to change your structure. But say like, hey, if you're an S corporation, for example, the first thing is staying compliant within that. You do have to pay yourself reasonable wages, and making sure, the biggest piece is making sure like, hey, you're compliant. So am I taking the right amount of distributions? Is my salary correct? Also, the next thing is, once you're giving yourself salary, you're paying in payroll taxes as well as an employee and employee. So it's always good to make sure you're within that fine line. You're not overpaying or underpaying. So it's good to reassess that. And the next thing is paying your employees. Sometimes you can pay them as 1099 contractors. So when you're kind of hiring a new associate on, is it more worthwhile to give them a contractor or a W-2? Because if you do give them a W-2, you're paying them unnecessary self-employment taxes. So sometimes they like it as well, like they themselves get the full amount and they can go ahead and consider themselves as a corporation. And then within that, they may receive additional deductions on their side. And then on your side, you just save the payroll taxes directly. So it is a little bit easier, but it's good to reassess that. Every state has their own layer of regulations and laws, but it's always good to monitor your layer of just salary and compensation within you and your employees.
This one isn't a huge one, but it's my understanding, at least it used to be true, that as an owner, if you're a sole proprietor, not if you're an LLC, I don't believe, but as an owner, you can also self-exempt from Medicaid and Medicare. Or at least that's how it used to be. I don't know if it still is. I haven't looked at trying to save that little money in years. So.
Yeah, so under sole proprietorship, you're subject to self-employment. Essentially how it flows, you're assessed at 15.3%, but there's another form out there where you deduct that, and then you deduct that 7.65 back. So that's kind of how it flows out.
All righty. Well, guys, that just made me think of an interesting tax structure. If you paid yourself as a 1099 employee and that 1099 employee owned a single proprietorship, I bet there's some juggling we could do with the numbers there to make things come out in our favor. But discussion for another day, my friend. I don't know about you guys. Tax law is fascinating. It's more fascinating the more money you get to study it. And the more money you get to study, you don't have to be a CPA. You just have to have a good CPA and learn some stuff. Saving money is exciting to me because it's money I don't have to give the government. And I think I know how to spend my money better than they do. So if you don't agree, by all means, ignore this podcast. But if you do agree that you spend your money better than the government does, maybe you should contact Harsh or, some other really good CPA. I happen to know he's a really good one, so I'm going to have him give you his information one more time.
Yep, please go ahead and call me at 224-625-0484. Additional ways to contact as well as directly through our website, hmpconsultants.com. Go ahead and send an inquiry there, and we could go ahead and schedule a meeting together. It's a quick analysis, free of charge, where we'll just talk about your business, additional findings, and kind of draw out a plan. It's just essentially help you save more additional layers of money going forward and how we can just change your business overall.
Absolutely fantastic. Well, guys, thank you for wasting another hour of your life listening to the sound of my voice. I hope that this has been an educational podcast for you, and I hope that the time that you spent getting to learn a little bit more about tax law and about some of the deductions that you can take as a practice owner end up profiting you in the end. Until the next time, thank you for being a member of the Business of Dentistry and a subscriber to the Dear Doc podcast. And on your way out, go ahead and smash that like and subscribe button. See you later, guys. Harsh, thanks again for coming.
Thank you.